with yet another juicy video to get into. This time around, I'm going to react to a Seeking Alpha article. So I think specifically, I didn't came across this article myself. It was somebody from the community that actually sent it my way. So it has a very intriguing title. Alibaba, fortunes will be lost. He used the word will, not might. So I think this author, he's not the first time appearing on my channel before. I think I've reacted to one of his previous article. He has been an avid writer on Seeking Alpha. For those of you who are interested in having a subscription, I do have an affiliate link down below. I think you do get some discounts for their annual subscription if you do use my link. But Mr. Bo here, he's a pretty controversial figure, at least in this Alibaba space, because he hasn't been very kind towards whatever he has written for Alibaba thus far. So of course, when we do a reaction video, we have to keep it entertaining. So sometimes maybe some sort of figure of speech or whatever words that I employ in this video, it's not targeted to him, but it's targeted to his arguments and whatever is written in this article specifically, just so we are clear. I'm not trying to pull him down or anything. But if you look at this article, it's pretty interesting. It was posted on November of 21st, 2022. It has garnered around 96 comments and a total of 9 likes. That's a very interesting ratio. So let's jump right into it. So just some context before we continue going through the article. He posted this on Seeking Alpha on the 21st of November. And I think since then, since the 21st of November, Alibaba has actually rallied for around 17%. So fortunes will be lost. I'm not too sure whether is it the bulls or the bears. So let's get right into it. But of course, I know short-term market volatility, the market can just be extremely euphoric or it can be extremely pessimistic. So short-term performance don't really mean anything. But let's really come to address the different arguments that he put forth. So the summary. Alibaba's mixed Q2 results show that the company is more than likely to continue to underperform as long as the structural issues of China's economy are not resolved. First argument, structural issues with the Chinese economy. The devaluation of the yuan along with the constant implementation of movement restrictions and a declining demographic would continue to hamper Alibaba's business in the foreseeable future. So he made 3 subsequent arguments. First one, talking about a structural issue of Chinese economy not being resolved, the devaluation of the yuan, the constant implementation of movement restriction, essentially the pandemic controls, and the declining demographic. So these are probably his 4 main concerns and 4 main arguments. So Alibaba continues to be uninvestable at this stage, despite trading cheaply solely based on the current fundamentals. And then he said that if you want to sign up for his, I don't know, exclusive idea, internal community, Black Square Capital, whatever. I'm not here to help him promote. I just want to take apart his arguments. So first, after Alibaba's earnings, it's safe to say that the company is more than likely to continue to underperform due to Beijing's inability to quickly solve the structural issues that the Chinese economy is facing. So the devaluation of the yuan, along with the decrease in consumer confidence caused by the zero COVID policy and a decline in exports. So despite all the chatters, millions of Chinese continue to be under strict movement restrictions to this day, while the improvement of the Sino-American relationship is nowhere near in sight as the risk of a possible trade war between 2 of the biggest economies in the world grow. So now he brought in geopolitics in the picture as well. Okay, sounds good. We are off to a great start. So now he started off with this subheader. China's economic miracle no more. Very interesting. So a few weeks before Alibaba's reported its Q2 earnings result, I wrote several articles on China's latest National Congress of the CCP. In them, I've explained why its outcome would have negative effects on the company going forward due to the abandonment of market reforms along with a call for the redistribution of wealth, which is unlikely to fix the structural issues that the Chinese economy is facing. So if you actually follow through the way I highlight his particular article, the blue ones are where I slightly disagree because it's a very lofty topic where you start talking about geopolitics, the US-China tension. Truth be told, there's no correct answer to it. Many of it is just what ifs, what nots, and your own opinions. So I'm not going to spend too much time on that because it's purely opinions. He can think that it's bearish for the economy. I can think that it's bullish for the economy. We can each make our arguments, but only time will tell who's right. So let's not waste too much time. So when the Q2 results came in last week, it became obvious that the recent policies that are implemented would make it even harder for Alibaba to deliver the same exceptional results. While in Q2, Alibaba generated 207 billion renminbi in revenue, up 3% year-on-year, the revenue of its core commerce business, which accounts for the absolute majority of the overall sales, nevertheless decreased by 1% year-on-year. And I agree, I think this is one of the major concerns for Alibaba shareholders. So of course, some of you might argue that the core business is deteriorating, but some others might be hopeful for other business drivers as Alibaba continues to drive growth in other business aspects. So I don't really see a very contentious point here. But that said, it's true that it's the absolute majority of its current business, but this deterioration, it's not like it's a negative 10, negative 20% like Intel, for example. It's a decrease 1% year-on-year. And truth be told, when I look at Alibaba's closest competitor, which is JD.com, they grew their revenue in that same quarter by 7% year-on-year. So it doesn't really specifically screams at me that it's an Alibaba specific problem, but it's an e-commerce problem by and large. That being said, I would like to counter myself because I would like to remain objective. Pinduoduo has recently announced their third quarter results as well, and they actually grew their top line revenue by 65%. 65%. But I'll dedicate a separate video to attempt to explain to you why I think there was such a huge disparity. But long story short, just to give you a one-liner, essentially, Pinduoduo targets your non-discretionary products, which is basically your essentials like groceries and all the lower tier items. And if you're to compare it to the counterparts of Alibaba and JD, Alibaba is more of a catch-all, they do everything, while JD on the other hand actually targets higher up the value chain. So if you're to really look at the entire e-commerce industry in totality, we know that the Chinese economy is experiencing some sort of turmoil. So many people have cut back their discretionary spending and people are just spending on the core essentials like groceries, which was why Pinduoduo's business model and business positioning essentially captured this entire swaths of demand, especially during these trying times that China is currently in. And I think it's also rightly reflected in the stock itself. You can see that year to date, Pinduoduo is actually up 53%. Now, moving on, Mr. Bo continued to assert that such a decline was mostly expected, as currently China's consumer confidence index is at a historical low, even lower than it was during the peak of the pandemic in 2020. So this is a result of the constant implementation of movement restrictions, along with the increase of structural risk within the Chinese economy, which hampers economic activity. So he made an extremely bold claim here. So I think without any context, people reading this article, they'll think that, hey, it's true. I think China's economy is in pretty now, and there's a lot of concerns about Chinese consumer sentiments. And when you are being served with this graph, China Consumer Confidence Index all the way from 2012 to 2022, it essentially looks like it fell off a cliff. I think it's at around sub 90 levels, closer to 85 I guess. But I think just to be a little bit more skeptical and a little bit more critical, I went on to just Google on Y charts. What is the US index of consumer sentiments right now? And surprise, surprise, the US consumer sentiment is currently also at a 5-year low. It's at 56.8 now. And if you'd like to compare with what Mr. Bo asserts, he said that the consumer index for China is even lower than the peak of its COVID-19 pandemic in 2020. And for the US index, it's the same. It's also lower than the pandemic lows back in 2020. So what exactly is he trying to assert? On that same note, I don't see analysts painting a doom and gloom picture for all these American companies just because the consumer confidence index is low. In fact, I think many people are still hopeful because America didn't go through a recession. And many of these earnings reports that are released by many of these big tech companies or all your conglomerates are still beating analyst estimates. So what exactly are you trying to prove here? I don't know. It just seemed like you're trying to cherry pick data to fit your narrative. I think that's that. Now, he then continues his argument talking about the devaluation of the currency. So what's also important to note is that due to Beijing's decision to devalue its currency in recent quarters, Alibaba's business stopped growing in dollar terms. I don't really know why is this obsession in trying to understand the currency fluctuations between the renminbi and the USD. Like you said, a majority of Alibaba's business is still situated in China. So their cost is in renminbi, their revenue is in renminbi. So why exactly is FX risk a very big concern? I don't really know. So I think the funny thing is, he went on to say that This shows that the devaluation of the Chinese currency is a major concern since it hurts Alibaba in dollar terms and make it harder to beat street estimate. So the main argument for the risk of a devaluation of the currency is because Alibaba is unable to beat street's estimates. I'm quite sure many of these street estimates, especially for analysts that are working in Hong Kong or China, they are giving estimates based on a renminbi denominated currency. I'm not too sure why everybody is obsessed with this USD denomination. But anyhow, he continues on. While recently there were talks about easing the zero COVID policy, no major steps have been taken so far, as millions of Chinese people continue to be in lockdown in various places of the mainland to this day. And I think after this article, just last weekend, there seemed to be major development. So I can't fault him for that. This makes the efforts of the Chinese government to stimulate the weakened economy via different fiscal and monetary programs even more difficult. And I actually do agree to a large extent because of consumer sentiments and investor sentiments as well. So this could force Beijing to devalue its currency even more as the exports fail to increase amidst a global slowdown. So I think I just wanted to give more context with regards to this idea of China being an export-driven country. So similarly, just hopping on the macro trends, all these are simply just Googleable. I believe many of you have the ability to Google. I just want to see the percentage of Chinese exports versus the entire GDP percentage. And as you can see in the early 2000s, that particular decade, China was essentially ramping up its economy via being export driven. So back in 2006, that was the peak where exports actually drive around 36% of their GDP. And from then on, at least in the last decade or so, there's a steady decline in terms of solely relying on being export driven. And at least as of 2021, it's around 20% of China's GDP. So I'm not too sure why is there this constant obsession saying that, oh, if China is unable to hit its export targets, the CCP will devalue its currency until it becomes like banana money or something. I mean, that's at least the feeling that I'm getting from how he writes his article. Maybe I'm a little bit too sensitive. You can leave in the comment section down below if you have that same feeling. And now, what's worse is that as China enters a growth crisis, which could last for a while, there's no guarantee that it would be able to successfully exit it and return to record growth levels. You know what else is a crisis? You not smashing the like button. That's the worst crisis any YouTuber can get. So remember to help gently smash the like button before we continue on. Of course, I do agree that there are currently many experts opining on this entire population time bomb that China is experiencing thus far, which is also why if you were to actually observe how the CCP has positioned itself for the upcoming 5 years, they focus on quality growth instead of quantity. But long story short, it does seem like China is focusing on going up the value chain. So for myself, I'm also unsure whether China is able to overcome this population crisis. Many of these claims of a population collapse. A population or a country doesn't collapse in 1 or 2 years. It collapses in the following decades. These sort of things takes time to play out, and you might want to give the benefit of the doubt of the Chinese government into thinking that whether they are able to pivot from here on. And I think it's particularly pointless to make such assertions because nobody knows the answer. Stop wasting your time on these sort of things. Instead, focus on the business. If your biggest bear thesis was because Alibaba is going to lose out to competition because Pinduoduo managed to grow their revenue by 65% while Alibaba only managed to grow by 3%, maybe you'll be able to catch more of my attention. Now, he goes on to substantiate his claim from the Shanghai Academy of Social Sciences, saying that China experienced its first population decline and there's a constant decrease in the fertility rate. So by the end of this current century, which is 2100, that's like in 80 years time, China's population will decrease to around 600 million from 1.41 billion last year. What's your point? What are you trying to say? Even at the end of the century, if this prediction were to really come true, if China has 600 million population, if they're able to hit half the GDP per capita of the USA today, the economy will be of the same size. And if they're able to hit 3/4 of GDP per capita of the USA today because of the upskilling and going up the value chain, it's still going to be a bigger economy than the US. So what's your point? And it's still 2 times the amount of population that the US have today. So I honestly don't know where these arguments are going. It's really, I'm just dumbfounded and lost for words. Finally, he went on to talk about his valuation model for Alibaba. So with that in mind, it makes sense to update my discounted cash flow model, which back in September showed that Alibaba's fair value to be around $128 per share. So after writing so much things, and then you're telling me that, hey, Alibaba's fairly undervalued based on the writing of this article, which is on the 21st. I think on the 21st, Alibaba was actually close to around $75, $70 to $75. How much of a margin of safety is that? I think close to 40%. But okay, let's see what he has to say. So this time, he has made 2 changes to his model. First of all, I changed the top line performance forecast, which is mostly in line with street expectations, due to the release of the new earnings report that caused me to revisit the revenue outlook. Secondly, the share count data in the end was updated as well, since due to the share buyback, the total number of shares outstanding has slightly decreased. Okay, so essentially, he's not making a forecast on his own. He's basically following street expectations. And we all know Wall Street analysts are all cream of the crop. They're all the smartest in the industry, and they exactly know how things would play out. So I'm going to give it to him because personally, I also love using analyst estimates as my conservative assumptions, but we shall see how things play out. But I think in order for you to have a greater appreciation of what's to come, it's better to really try to understand the industry from the ground up rather than just rely on analyst estimates. So based on analyst estimates from FY24 onwards, it's probably going to normalize its earnings growth again, or revenues growth, back to 13%, 10%, and then moderate off to 5.9% and 7.8%. Interestingly, I think there was this subheader that he just used. I've forgotten what is it. China's economic miracle no more. And he's basically trying to construct a narrative that China is going to collapse on itself. But clearly, analysts is still saying that, maybe Alibaba's able to grow revenue by 13%, 10%. I don't know how, but it's quite interesting. I don't know whether he's concerned about analyst estimates here. But anyhow, the updated model actually shows that Alibaba's current fair value is $264 billion, which is an implied share price of around $115. So I think this is the interesting part. Regardless of how big of a bear you are on Alibaba or on any of these Chinese tech companies, valuations is never your bear thesis, because deep down, we all know that they're all dirt cheap, but that's that. However, several things need to be mentioned here. First of all, even though Alibaba is undervalued solely based on the fundamentals, we shouldn't forget that for several quarters in a row, the stock has traded below its fair value and nothing prevented its price from further depreciation. Therefore, the fact that at first it appears that Alibaba is undervalued shouldn't be the deciding factor on whether to invest in the company. And I totally agree. I even highlighted it in green. Being undervalued doesn't mean that you should enter or you should buy a particular position, because I'm sure there are many companies out there that are quote-unquote undervalued based on some manipulation of the Excel and thinking that you really got the intrinsic value right. But that said, I think that's the core of trying to invest, right? You try to estimate a value, you think that it's cheap, and then you just buy and wait, because the only edge you have against the market is time. I'm not too sure whether the intrinsic value of these Chinese tech companies will be unlocked. Personally, I think they do. That's why I have a huge proportion of my portfolio in them. But you can be perfectly uncomfortable with that and don't have to touch them. I'm not asking you to buy them, but that's just a funny observation. And last but not least, he said that a single bump of a 0.5 basis point to 1 basis point for WACC alone would decrease the fair value of Alibaba by several dollars per share. I honestly don't know what is he trying to achieve with this line. Probably trying to smoke people that don't have a finance background. So for those of you who don't know, I think just to give you a quick crash course. So what does WACC means? It means weighted average cost of capital. Essentially, most finance people use this number to attempt to discount the future cash flow being provided by the company itself. So you can see back to his own model, the WACC he used is actually 7.29%. So in the formula of a weighted average cost of capital, there's actually 2 portions. One is the cost of debt and the other one is the cost of equity. So some of you might ask me, so how do you actually derive these numbers? There are a myriad of different ways to derive the numbers, but essentially they're just trying to look at the cost structure of a company, because we all know that every single company out there is probably being capitalized in 2 different versions. You either take on debt from the debt market, or you issue shares or use equity instruments to raise funds. But the funny thing is, this rule actually applies to every single company, not only Alibaba. I don't really know why he just added this line. What is he trying to insinuate? I don't know. So I think the baseline, for those of you who don't have a finance background, you don't want to crunch the numbers, you don't want to calculate cost of equity, cost of debt, weighted average cost of capital, all this mumbo jumbo, just use a bigger discount rate. Use 12%, 15% to get a bigger margin of safety. That's the easiest way to try to get a bigger buffer. He says that the catalysts that were there even a decade ago are no longer present now to help Alibaba improve its overall performance going forward. At the same time, the amount of economic, political, and geopolitical issues that are outside of the company's control continue to increase, which hampers its business and ability to create additional shareholder values along the way. Considering this, I continue to believe that it's better to avoid Alibaba and Chinese stocks altogether. I guess Pinduoduo is also a bad investment, having a 50% year-to-date performance. Pretty bad. I think we should all stick to the US market. With that, I'll see you in the next video, but more importantly, I'll see you on the moon, guys. Goodbye.